Hey guys, hope you are all having a great morning. Today we continue discussing crypto market manipulations. We just finished going over the 7 main methods by which Wall Street and other groups use to play with the prices of crypto. Since crypto is becoming more mainstream each year, and many ETFs are starting to follow the prices of different assets like Bitcoin, you can expect some of the biggest institutions in the financial world to want to control as much of the movements in crypto as they can. What we are going to do today is discuss the influence that all these 7 methods of manipulation have in more detail, while also provide some awareness of the real scope of how much bigger this manipulation of cryptocurrency markets is. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. So, we talked and discussed in detail each of the 7 manipulation methods, which were pumps and dumps, wash trading, order booking, front running, insider trading, DDoS attacks and stablecoins. As schemers employ more complex manipulative tactics to tilt the prices of crypto to their favor, the question about regulation comes more prevalent. We have seen Gary Gensler from the SEC increasingly talk about how he wants to introduce regulation for crypto in order to protect consumers. We have seen governments outright ban crypto precisely because they are unable to control it. At the same time, critics have come out against regulation of crypto, saying that overregulation will impede organic growth for these assets, and they have a point. So the question then becomes, how can we avoid overregulation while maintaining a healthy balance of authority that doesn't disrupt the markets but provides a comfortable level of protection to investors? To avoid overregulation, the first thing we need to do is fully grasp and understand why markets are so easily subject to manipulation. We want to highlight the possible market vulnerabilities and how these vulnerabilities influence the success of each of the methods of manipulation we discussed these past 2 days. The huge analysis of the 38 different studies that identified the 7 manipulation methods led to the identification of 6 main vulnerabilities in the markets. There were more found, but these 6 we are about to discuss were the biggest and most serious ones, which is why we are going to focus on them today. These vulnerabilities will determine the level and impact of success for crypto market manipulation. The vulnerabilities are anonymity, market regulation, market barriers and inexperienced investors, standards and sophistications of exchanges, social media and blockchain design. Depending on the stands and sophistications of a given exchange, all 7 manipulation methods make said exchange vulnerable. Anonymity and market regulation also exist as vulnerability for all 7 market manipulation methods. Social media users are vulnerable to manipulation of pump and dumps for the most part. Market barriers and inexperienced investors are vulnerable to pump and dump, wash trading, front running, order booking and insider trading. Blockchain designs and their ecosystems were vulnerable to front running and stablecoins only. The most noticeable aspect of all of this is that the absence of regulations and standards for individual exchanges positively influenced the success of all manipulation methods. By not having any standards, you are essentially guaranteeing focused manipulation to take place. This comes in direct comparison to normal exchanges, which require a variety of licenses depending on the country they offer services. Furthermore, one of the biggest and most surprising conclusions that were derived was that by being the target to manipulation techniques, crypto exchanges played a full active role in the market manipulation themselves. Several studies demonstrated exchanges actively involved in the manipulative methods, often being observed running wash trades and artificial inflation of volume. That is, the exchange where you buy crypto is actively trading against you. Imagine if Fidelity or another broker actively engaged in artificially inflating the volume of a stock as it was displayed on the information charts while they also wash trades, which, as we discussed, is when the manipulator sends a sell order while buying it at the same time to give the wrong and false impression of liquidity. As you can see, this would be wildly problematic for stock traders, so imagine the impact it has on crypto investors when exchanges have no regulation and can do whatever they want. Another huge problem that arises as part that gives way to vulnerabilities is the fact that because there is little to no regulation, processes between exchanges vary widely. For example, some exchanges do not require any form of identification or address. This makes it incredibly difficult for authorities to identify criminal and suspicious behavior. This can lead to tax evasion crimes, terrorist financing, and even allow the misuse of insider information by insiders within exchanges or blockchain companies. As we mentioned yesterday, people working with sensitive information can easily pass it along or make trades on decentralized exchanges to stay ahead of huge price movements they know about. This is all capable of happening because there is no regulation that sets a standard of conduct of what is or isn't allowed. Yet, despite all this evidence, the argument that exchanges are the sole root cause for cryptocurrency market manipulation is flawed. For example, social media is always going to have a big effect on asset prices. Inexperienced investors will always flock in herds to follow favored leaders that tell them what to buy, because it is easier to just follow what someone says rather than taking time and effort to study charts and do your own due diligence. There is nothing a crypto exchange can do about this. Furthermore, we have seen the media slowly trying to set the narrative that perhaps there should be a government crackdown on social media users that pump stocks. I am sorry, but everyone is allowed to tell others about what they think are great investment opportunities. The responsibility falls on the individual to make sure they are making sensible decisions. This is a problem that, in my opinion, arises from the fact that there is so little to no financial education for people outside college if you decide to study finance or a related field. Cryptocurrency markets also allow pretty much any person to be able to sign up to an exchange for free. Inexperienced traders are likely to fall for manipulation, but once again, that is the cost of the risk that they imposed on themselves, and not a fault by crypto exchanges. The literature of the studies we have gone over is very promising in understanding the role of Wall Street and other actors into the manipulation of crypto exchanges. I would add, however, that the research into this field is at a very early stage, and that though we should take into consideration these studies, we should not start formulating policy based on the strength and conclusion of such studies. The scope is still too narrow, especially given the growth we have seen in crypto this past year. Exchange data, since it's unregulated, is often very hard to obtain, and can be very expensive for those paying for it. Another thing we must consider is that the literature in crypto market manipulation methods is very in-depth, and lacks a lot of possible solutions to fix the problems. This is a problem because any derived conclusion will be flawed, since the phenomenon itself was the only thing studied, and the underlying causes and issues are ignored. When it comes to policy making, we need to analyze and make plenty more studies in order to find a perfect spot in which we can regulate and the extents of such regulation. The SEC seems to be ready to start regulating cryptocurrency, even without a solid leg to stand on in the eyes of the law itself. Let me explain. The rapid expansion of crypto has placed it in a weird regulatory gray area. The IRS classifies crypto as property, but the CFTC considers crypto to be a commodity. The SEC has said that crypto should be looked at as a security depending on the facts and circumstances. Now, they are showing that they are ready to step in and start regulating it accordingly, especially after the upcoming offering from Coinbase, which is the largest cryptocurrency exchange in the United States. Coinbase recently went public, and was planning on launching a program called Lend, which would allow investors to let others borrow from them a form of stable coin whose value was tied to the US dollar. This would have made Coinbase Lend offering a very attractive investment opportunity for consumers who wouldn't have risked investing into the crypto in the first place. The SEC, however, stepped in, and threatened Coinbase that it would sue them if they launched Lend. The SEC, however, wouldn't tell Coinbase why it considered Lend to be a security. It is speculated that they would use decades-old Supreme Court cases that establish any potential security, such as crypto, as part of a prism in which the SEC would be allowed to regulate. The SEC didn't officially comment on the matter, and Coinbase said they wanted formal guidance from the SEC and how they were going to use those cases, which the SEC declined to provide. To the smooth brains, this is very confusing, but to the wrinkled brain, it makes total sense. You see, the SEC knows exactly what they are doing here, which is asserting authority and regulatory control over the world of cryptocurrency banking and finance. Cryptocurrency has been aggressively moving into the banking sector, offering services that were once usually reserved for traditional banks. Now, we have crypto companies offering interest-bearing accounts, debit cards, credit cards with cryptocurrency rewards. We have had politicians called these shadow banks, which, to be honest, I would have to agree, but I am just a normie on the internet. What you need to know is that SEC Chair Gary Gensler agreed to this remark too, advising lawmakers to prioritize legislation that addressed crypto trading and lending. Their interest with Coinbase all of a sudden suggests to me that it's a sign that every single crypto finance company that will follow suit in growth will be expected to follow rules established by the SEC now. I know this may sound enraging, but I don't think this is a bad thing at all. If there are going to be deeply financial ties to crypto, these crypto companies need to be regulated. After all, they are now operating like banks, offering credit cards and debit cards among other similar services. What my concern is in regards to regulation falls on the bucket of the full scope of what the SEC intends to go. Again, overregulating the markets will not benefit anyone, and too little has shown to allow schemes and manipulators to have too much power controlling prices. What I personally believe should happen is that centralized exchanges should be regulated, but decentralized ones need to be protected. The right of the individual to create a platform or system to allow others to trade should not be forced to follow SEC rules, because I will explain in full detail, it actually comes in direct conflict with the First Amendment. However, that is a topic that I am going to talk about tomorrow. I think this is a great place to stop. All in all, today we went over the comprehensive overview of the vulnerabilities that surged and were highlighted as a result into the 7 manipulation methods that Wall Street and other schemers love to use. These reviews were a bit systematic, and a fully comprehensive design for future studies needs to incorporate a broader scope in their analysis so that we can understand the underlying causes that causes things to happen the way they do, instead of just focusing on what happened as an in-depth review. Let me know what you think down in the comments. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day, and I hope to see you later today on the recap video. Until then, keep on buying the dip into the moon.